Okay, the next problem up for chapter 3 is E310. E310 gives us a series of transactions for Greek Peak and asks us to record the journal entry associated with each transaction for December 2013. So, important thing to note right here, we're considering December 2013. Okay, what I've done for you is I've written out some of the transactions already to save us some time. So here's some of the journal entries, and we'll go over them still, but I've kind of written them out to save us some time, and then we'll go over the first 4 together. So we'll do those together. All right, on the first one, it says A, borrowed $500,000 from the bank on December 1st by signing a notes payable that's due within 6 months. So, we received cash of $500,000. That's how much we borrowed from the bank. We signed a notes payable, right? And the notes payable is short term. Why is it short term? Because it's due within 6 months, so it's less than a year. So we'll put $500,000 on the credit side as well. All right, the next part suggests that Greek Peak purchased a new snowplow for $20,000 cash on December 31st. So, December 31st, in our month, we purchased equipment. We're going to call that snowplow equipment because, you know, it's a piece of equipment that they're going to use. It cost them $20,000 here, and they paid cash in order to purchase it. So we'll put $20,000 over here on the credit side, okay? Next, it tells us that they purchased ski supplies for $10,000 on account. So, ski supplies will be our account, but one important thing to note, okay, is that a company can set up its chart of accounts. The chart of accounts holds all the frameworks for all the accounts that you'll use. It divides up the expenses, divides up what specific revenues you'll have, et cetera, et cetera. So the chart of account lists out all the accounts that are going to be used within the general ledger, okay? So a company can set up its chart of accounts to be as detailed as it desires. In this instance, they put the term ski in front of supplies. Supplies would be the general account, okay? If you were operating, let's say, a hair salon is a business that I used to do accounting for. So if they had a hair salon and they had a specific type of revenue or a specific type of expense that they wanted to denote, they could set up that account. For instance, they might do dyeing of hair, right? Some sort of color treatment or something like that. So they could have a dyeing or color treatment revenue account, or they could have some sort of dyeing or color treatment supplies expense account, okay? So that we know exactly what type of supplies it is that we're actually using or supplies expense that we're actually incurring, okay? So here they put the specific descriptor over here of ski supplies for that account. And it tells us that we pay on account, so that phrase on account indicates that we're using accounts payable. So here we'll credit 10. The next one, D, says that we incurred $22,000 in routine maintenance expense for chair lifts, and we paid cash. In this instance, we used the repair and maintenance account. Again, you could be as specific as you wanted. If you wanted to have a specific repair and maintenance expense account for chair lifts, which I don't imagine a company really doing, but they could do that, you could have that descriptor in front of the expense account. And then it says we paid cash for it, so we'll credit cash. And the amount, I think, was $22,000. So $22,000 for each. Okay. All right. So for the rest of them, I've listed out the journal entries. Let's go over them briefly here. On E, it says receive $72,000 for season passes beginning in the new year. We debit cash because we received cash. We credit unearned revenue for $72,000. I've relived that U/R for $72,000. Why did we not record revenue? Remember, we are dealing with December 2013. The cash was paid to them for season passes that begin in the next year. So we've not yet earned the revenue. We have not made available to the season pass holders the mountain or whatever it is that they're skiing on, right? They have to actually have the service available to them. It's their decision whether or not they use it, but the company's responsibility is making that service available to them. So we don't do that till next year, so right now it's considered unearned revenue. On the next transaction, it tells us that daily lift passes were sold this month for a total of $76,000 cash. Well, we debit cash because we received cash. This time we get to credit lift revenue. Why do we get to credit revenue? Why is it that we've earned our revenue? In this instance, we sold daily lift passes, which means the service was provided for that day. And the lift passes that we sold were for the month of December. So we provided the service for them already, therefore we've earned the revenue and we get to record revenue, as opposed to here, we will not be providing the service until the next season begins. All right, on the next one, it says we received a $320 deposit on a townhouse to be rented for 5 days in January 2014. Again, we're dealing with the month of December. Here we receive cash for a deposit for January the next year. Therefore, we credit this to either the deposit account or unearned revenue. I would accept either account. Deposit would note that you have a liability to pay back if that deposit is due back to them. But if we're going to apply that towards the rent that they have to pay for that cabin, then we can also credit unearned revenue. So either account will be fine with me at this point, okay? But we do have to debit cash because we receive the cash at this point. Next one says, paid half the charges incurred on account C, or on account in letter C. Okay, so letter C, let's go back to that one real quick. We debited ski supplies and credited accounts payable. For the full amount was $10,000. Here we've now paid half, so we're debiting accounts payable to reduce our obligation. It's bringing our obligation down. We no longer owe it. And we're crediting cash because we're using cash to pay it, okay? $5,000 is half of the $10,000 here. And the last one, it says we paid $18,000 in wages to employees for the month of December. Okay, we're dealing with the month of December, so that's good. We debit wage expense here, $18,000, because we were provided services by the employees. They've worked, they provided wages, okay, so we owe them money. We debited wage expense, and then we actually paid them. If we had not paid them, we would have credited wages payable because we still owed them money. But since we actually paid out what we owed, we can credit cash here. Okay, the last requirement of this problem is to create a preliminary income statement. So, scanning through all of our journal entries that we have, we determined that the only amount of revenue that we actually have recorded was over here when we sold the daily lift passes here. So we have $76,000 in revenue. For expenses, we incurred a repair and maintenance expense here at $22,000, and we also incurred wage expense at $18,000. This gives us preliminary net income of $36,000. Remember, revenue increases with credit. So if you wanted to know which one was revenue, you simply scan the credits. Notes payable, not a revenue. Cash, not a revenue. AP, not a revenue, et cetera, et cetera. And then you'd look for expenses on the debit side because expenses increase with the debit. So scan through here. Cash is not an expense. Equipment's not an expense. Ski supplies is not an expense. Repair and maintenance. There we have our first one, and you continue that process until you find the expenses. These should be all the requirements for E310. Please send me any questions that you have.